Good afternoon, everyone. We've turned off, yes, I can see people. We've turned cameras and mics off, so you can turn them back on, but if possible, please refrain from doing that. Leave your mics and cameras off. I'm just going to hold on a little while. I can still see that a number of people are entering as we speak, as the numbers are going up. I think we've got 100 or so registered participants. I know that Zoom sometimes takes a little while to load. Yeah, so we're just going to hang on a little while. Let's see if I can see the participants. Nice, I recognize some names. That's good. It's nice to know I've got some friends and clients online. That's good. Excellent. Okay. Yeah, so if you can get onto a bigger screen, I will try and explain it. But anyone that knows me knows how I love a spreadsheet. And if they really know me well, they know I love to call my spreadsheets a compendium. So I'm going to share my screen. Right. So yeah, so large screen has helped. Just these are illustrations that I'm going to be sharing. So there's a big caveat comes with that. They are illustrations, they're not advice. Everything should be followed up with advice. There's a recording of this which can be shared. The spreadsheet themselves will not be shared. I think you'll understand why. It's badged up about inheritance tax. I am just going to start, however, just very briefly with the NIC changes. It won't take very long. So there were two changes to employers' NI because working people don't pay employers' NI, so that was fine to change that one. There were two changes: a reduction in the threshold at which employers start to pay employers' NI, and an increase in the rate from 13.8 to 15%. Just quickly mop this up. That apparently is the average salary in the UK. So for an individual on the average salary, that's our threshold. So that's the amount that's subject to employers' NI. But of course, the rate has gone up from 13.8 to 15. So the total increase for one individual on the average salary is £861 from April next year. So say you had 100 employees that happen to be on the average salary, then the total employer NI increase from next year would be £80,600, which I suppose after corporation tax relief is a net impact of about £60,000. The sort of the way they framed it was that because they were increasing this employer's allowance, it would not hit the smallest businesses, which is true. They won't hit the smallest businesses. I think it can have a disproportionate impact on businesses that employ, say a tourist type business employing part-timers or students working during their school holidays, because if they don't get to, they may not get to £9,000 during the year at all, but they may get to £5,000. And so for those individuals that fall between 5 and 9, those part-timers, the increase is not 1.2%, it's effectively 15% of that difference, if you like. So I think it can have a disproportionate impact on certain employers. And I could see I could see how this is a daft idea, but I could see if you were a pub and there was a pub across the road, you might swap your staff halfway through the year to keep, because it's done by employment, not employee, and then you could avoid coming over the £5,000 or very much restrict it. So, but that's just an aside on the NIC. The main thrust of this is the inheritance tax changes. So in summary, we have a situation where business relief, we used to call it business property relief, we now call it business relief, and agricultural property relief has reduced from a full relief, 100% relief, to a relief of 50% on the excess over £1 million. And that £1 million is per individual, not per business. So if you have a business that happens to be worth 1 million and a farm that happens to be worth 1 million, or another business it's worth, it doesn't work like that. That million is like a lifetime amount for all your businesses and farms if you happen to have both of them. What the what happened was we had the announcement, and a few days later, it felt like after some tough questions, Rachel Reeves sort of tried to rail it back in a little bit. And out on the 6th of November came this example. This is not mine. This is essentially copied from the Treasury release of the 6th of November, where you'll keep hearing them talking about, well, if you've got, a farmer under 3 million won't be impacted, which is sort of nonsense, because you couldn't just have your farm at 3 million and have nothing else. And by the very nature of having something else, the likelihood is these would be tapered down. But we'll come on to that. Let's just explain what Rachel Reeves's take on this is, that if you have a husband and wife who happen to have a farm and farmhouse with a total value of 3 million, and they own that jointly, it's no good if one owns it. They've got to own it jointly, and they've got to leave it to their descendants or a trust. They can't leave it to each other, or you're going to have a problem later on. But so if you've got to get all the structuring right. But in this circumstance of a farmhouse, it could be a trading company, £1.5 million each. The idea is that each person has this £1 million allowance. If you combine the residence nil rate band and the normal nil rate band, then the taxable estate would be zero. They then gave that example of an individual who was not married or in a civil partnership, and so funnily enough, it's just 1.5 million. So that's really all they've put out. The issue with this for both trading companies or farms is this million is not transferable. Whereas we've been accustomed to the nil rate band and the residence nil rate band both being transferable. So you would have thought it would be the same, such that if for whatever reason one of the spouses owned all the assets and they were left to the surviving spouse, who then left them to the descendants, it would be just much easier and simpler if the spouse could have that 1 million as well as their own 1 million, have their husband or wives £175,000 residence nil rate band and their normal nil rate band, and that might be convenient just for the purposes of having the income to live on. Because one of the reasons farmers in particular, as I understand it from looking after the FUW, kind of leave everything with mum and dad until the very end is they don't have big pension pots. Because they're not made any real significant money. So they're relying on the asset for the income. So they need to leave it in their names, and then the kids inherit it on the death of the second one. So it'll be interesting to see if the non-transferability of this 1 million changes between now and April 2026 when these rules come into play. We don't have as yet any draft rules to actually look at. We've got a couple of quite slim documents that the Treasury released. So this here just really demonstrates the issue of that allowance not being transferable. So in the circumstance where you haven't either changed your will to leave your share to a trust, or you haven't changed the ownership so that it is owned 50-50, in order that you can leave half share to your direct descendants. So if things have not been done that should have been done, you'd be in a situation most likely where you'd not only lose the 1 million, but you'd probably lose the transferable residence nil rate band, because it would probably have been tapered to zero. Okay, so the transferable residence nil rate band, you don't automatically get it. It's only available in full when the estate is under 2 million. So if you had a situation where, for example, the whole of the £3 million estate was with, say, the husband, and I'm going to use a husband because husbands generally pass away before wives. So the husband has 3 million, leaves that to his wife. His estate is over 2 billion. His residence nil rate band is tapered by £1 for every £2 it's over 1 million. So once you've got to 2,350,000, funnily enough, there is no residence nil rate band. So not only do we lose the 1 million, we potentially also lose the £175,000 transferable band. So we may only have our own. So we take that one, and if our new estate now is more than 3 million, we're probably going to lose another one. So I take that one off as well. And so you could be in a situation where just by not getting the kind of the wills right, the ownership right, even though Rachel Reeves is saying this couple should have no inheritance tax, you could end up with £270,000 of inheritance tax. Not so difficult on a theoretical level to deal with that. Changing ownership of property can be problematic if there's debt on it. Changing the wills can be done. That's not necessarily a problem. I think it's more the practicalities of, well, I don't necessarily want to leave my half share to a trust in order that I can bank the 1 million, because I want to leave it to my spouse because actually they need the income. And I've not seen any of that playing out in the press, on Twitter or X. And I think that's a shame. I think there are some more details to this that need to be brought to bear and politicians, I suppose, taken to task. I've changed this one, so this one is almost now the same. So I don't need to do that. So the point is, things need to be done. The next question is gifting, because what I've seen a lot of the press in the press, and I suppose on X, is that everyone could avoid this just by giving things away, if they live the 7 years, there'll be no problem. What's, I think, grossly unfair about the gifting, of course, is that you've made decisions based on the rules, and if you're in your later years, you may be looking at a gift and thinking, well, I might not survive 7 years. If I'd have known about these rules earlier, fine, I may have passed the farm or the business on. Not that I particularly wanted to, because I wanted to keep it and I want the income from it, but that may have changed people's views on life. But by making it such that any gifts now are still going to be on the 7-year clock with the potential exposure inheritance tax, I think that's sort of grossly unfair. And one of the things that's really not coming out, which I think is really, really important, is that if you gift something, a business asset, you're normally going to hold over the capital gain, because if you don't hold over the capital gain, you're going to have capital gains tax to pay on the gift. And if you're making a gift, you've had no money to pay the capital gains tax. So of course, if you could, you'd hold over the gain. So this is an example of a farm, and I have one for a company. But let's start with a farm. It could be a sole trader business. It doesn't have to be a farm, just an unincorporated business. If that business was worth 3 million, and let's say the cost of that business was 2 million, if I was to inherit that business and suffer the inheritance tax, at least I could sell that business the next day and not pay any capital gains tax. Because when I inherit that business, the probate value becomes my capital gains tax base cost. Okay, so I'll say that again. This is really important. So if I inherit something, whilst I will pay potentially inheritance tax on it, for capital gains tax purposes, the base cost of that asset is equivalent to the market value when I inherited it, which generally means if I sell it the next day, there can't be any more capital gain. There can't be, therefore, any capital gains tax. The problem with gifting is that if you hold over the gain, you can end up in a situation where, in fact, you make things worse, not better. And how much worse you make them will rather depend on how big the gain is. So I'm going to change these numbers, but let's go through this as an example. So we've got £3 million of asset, farm, sole trader business. It cost us £2 million. Maybe we inherited it, particularly with a farm. So we've got a latent capital gain of £1 million. If we make a gift of that, and I might change some of these. Let's say make a gift of that, and we've got £1 million of the allowance. The spouse has used theirs. We've got our 1 million, and of course we can't have it transferred to us. We've got the transferable residence nil rate band. So let's pretend the spouse didn't have an estate of more than 2 million. We're not going to have our own because already we're over the £2,350,000. So we're only going to have the one that's transferred to us. We have our own nil rate band and we have our transferable nil rate band. So we take all those off and we've still got £1,125,000 subject to inheritance tax, albeit that's going to be at the 20% rate, not the 40% rate. So in this example, £225,000 of inheritance tax. The latent capital gets, if I, as a consequence of this being given to me, and my parent not surviving 3 years, I've got that bill. I may then think, oh, bugger, I'm going to have to sell this because I can't actually afford to pay the inheritance tax. So if I was to sell the whole thing, I would then incur capital gains tax on this 1 million. And let's assume the rate is 24%. So I've now got another £140,000 of tax to pay when I've sold the business. So the total, therefore, is the total of these two. So that's £365,000. If I had done nothing, sorry, if my parents had done nothing and I just inherited it, I'd have the same amount of inheritance tax, but I could have sold it the next day without paying any capital gains tax. So in this example, I'm £140,000 worse off. Okay. And if that was just say the gain's bigger, if that was only £500,000, for example, and some things go back a long way, it's catastrophically bad, isn't it? You've gone from having an IHT bill of £225,000 to potentially having IHT and capital gains tax when you sell it. And you might not sell it, but you may have to sell it. So that's pretty bloody awful. I'll turn it back to 2 million. So I've got £1 million gain. Now, of course, what happens is the inheritance tax tapers after 3 years. So really the purpose of this is to demonstrate that it never actually, it depends on the figures, but it may never actually get better. Because so if you take the inheritance tax here, so 20% of our amount, this is our tapering here. So after 3 years, you get 20% taper. After 4 years, 40% taper, 60%, 80%. And after 7 years, it all course drops out. So the inheritance tax becomes nil. But if you took, say, 3 to 4 years, okay, the inheritance tax will come down. Right, how am I showing this? My IHT is coming down. And my capital gains tax should be the same. Why is that all changed? There's a bit of there's a quirk there, isn't there? Let's move that. Right, that's more like it, isn't it? Yes, that's more like it. So now you can see that the total tax is coming down as the taper relief kicks in. But depending on the numbers, it might have been actually better to inherit it and receive the base cost uplift. So if the gain was not very much, just say that was £2.5 million, and so the latent gain is £500,000, then you can see that for the first 3 years, you're worse off. 3 to 4 years, you're still worse off, but not as bad. 4 to 5 years, you're still worse off. And then, after the tapering hits 60%, you gain. And I think this is particularly unfair to change the goalposts when you're in your, I don't know, I don't like to say an age, but for the more elderly who are looking at the 7 year clock and thinking I might not make it, I think it's going to be particularly difficult for them to make decisions on whether they make gifts or not. But I think they're going to have to look very carefully at, you know, what's the gain situation. I've now got one of these for companies, and it's probably going to be very, very much worse. Very, very much worse, I'm afraid. And the reason for that is I would say that 99% of my family companies have no base cost in the shares because the companies were set up with £100. And so unless someone's inherited shares already, it's pretty rare that there's any capital gains tax base cost in family company shares. I mean, it does happen, but I would say it's fairly rare, which means the gain is typically going to be the same as the value of the shares. So, you know, the latent capital gain is much more likely to be there and be higher. The other issue, and this is really important, if at all really important, this is like super critical, is that whilst we'll have this 10 years to pay the inheritance tax and it will be without interest, the chances are you've got to get the money out of the company to pay the inheritance tax. I would say, maybe not all of it, but I would say in the majority of cases, there might be a family home to be sold, there might be some liquidity, but I'd say if you had this sort of level of inheritance tax because of trading companies, it's going to be necessary to take the money out of the company to pay the inheritance tax. Now, of course, if you took it as a dividend and paid income tax, that would be horrendous. You'd be, in order to pay £1 of inheritance tax, you probably need to take something like £1.67 to £1.81, pay the 45% tax in order to have the pound to pay the inheritance tax. So actually, that doesn't happen. There is a special rule that allows a company to buy back the shares from the executors, from the estate, where the purpose of that buyback is to pay inheritance tax. And that special rule affords that disposal capital gains tax treatment. And so if you've inherited the shares, if you've inherited these shares at, say, £3 million, and say there's a £600,000 inheritance tax liability, let's just say that we've used our 1 million and we've got £600,000 of inheritance tax. If they've been inherited, there will be a base cost uplift. So the base cost of the shares will be the 3 million. If the company buys back £600,000 of shares, there would be no tax. So at least you can get the money out of the company without tax in order to pay tax, to avoid double tax. The problem, of course, is if you give them away during your lifetime, you would most likely have held over the gain. So when the individual has the shares bought back, assuming they can get a clearance from the revenue, so like I've got I think they would get one because the purpose would still be to pay inheritance tax. I think you'd get that tax treatment, that capital gains tax treatment. You'd still be paying capital gains tax. And so effectively, and what this will show is you'd have to gross up the proceeds to pay the IHT. So let's go through it. So we've got 3 million. You've got £1 million of allowance. And that should probably say BPR or BR rather than APR. This is going to be a trading company. We've got let's say we've got no residence bans. We didn't get them. We were over the 2 million, so they were the 2,350,000 each. So they were tapered to zero. So we've just got our normal nil rate bans. So we've got taxable 1,350,000. And why has it disappeared from there? Oh, that's taper relief. So there's no taper relief. So, you know, if we don't live 3 years, we've got the full inheritance tax, 20%, and it's tapering down. Okay, so 3 to 4 years, it drops to 216, 4 to 5, 162, and so on. So this is our IHT tapering down. But let's say now we thought, oh, crikey, but the money's in the company. We've got to get the money out of the company to pay the inheritance tax because haven't got enough money elsewhere. So that you do a purchase of shares, the company buys back some shares. Well, it can't give you £270,000 because you'll pay capital gains tax, it won't leave you enough. So you sort of gross it up. So you take £355,000 of shares, that incurs £85,000 of capital gains tax, and therefore you've now got the 270. Okay. So that means you are worse off than if nothing was done by £85,000 in this example. So what this shows is that, and because there's no basis in the shares, if we go back to this one, that it was like, because we have some sort of basis, you would hope at some point there comes a point where you win, if you like, where you get to 5 years, you're winning. But with a limited company, if there's no basis in the shares and you need to sell shares to pay the inheritance tax, it sort of brings into question whether it ever makes sense to do the gift in the first place. It almost becomes I need to make sure I do the 7 years, because if I don't, and the money's got to come out of the company, I'm actually going to make things worse. And this is it coming down. But of course, even at this point, how does that look? So that's, where do we start to win? So the inheritance tax, 270, and with the capital gains tax, 355. And if we get to here, so ignore all that, I've done all that one wrong. If we get to here, 125. So let me show you the tipping point in this example. I'm seeing it now. I've gone a bit spreadsheet blind. So 355 versus 270, 284, I guess, versus 270. So there's our tipping point. So after 4 years, in this example, the total tax would be 213. So that's better than the 270 and no capital gains tax. So we can see, so 270 was what we do if we did nothing, gets worse, still worse, and then as the tapering really kicks in, we start to benefit. So that's one to really look out for, and a lot of thought will need to be given to who owns the shares. Are they owned 50-50? Are they, if someone's say considerably older, actually it might make more sense that the spouse inherits them, because at least they'll get the base cost uplift on that inheritance, and then they give them away on the 7-year clock. So the latent capital gains tax exposure is very much reduced. But I wouldn't be surprised if some people looking at this and scratching their heads, and I would be. I was. It's why I did this. So it's not going to be a one size fits all. We've got to think about all the taxes, and we've also got to think about the income taxes afterwards. What income people are going to have, and try and craft solutions that fit the circumstances. But this will hopefully at least explain the sort of the considerations and what makes it difficult. How am I doing? I'm doing quite well. Half an hour. This was just so that I should have probably shown you this first. This is just a reminder, I suppose, that the rate is effectively half of the normal rate for business assets and agricultural property relief. And the effective taper reduces that rate. So if you made a straight cash gift, the rate for the first 3 years is effectively 40%. The effective taper reduces the effective rate of tax to 32% after 3 years, 24% after 4 years, 12%, 8%. And then, of course, if it's effectively for business assets, that rate is half. It's half of the normal rate, and you sort of see that in here. Slightly complicated figure because we're starting with not a round number, but you'll see it there. You know that if that is an effective rate. Is that the right one? Yes. So that there. Where was I? Oh, crap! Lost my track. That £54,000 tax on the 1,350,000 is effectively our 4%. So that's what it'll look like for trading companies and farms. That's the effective rate. Oh, I've got some on. I got some. Maybe I've gone past it. Maybe I've already changed it, Paul and Andrew. They've obviously changed the cell and they've told me to fix it, but I'm not sure which tab. Tabs. Shouldn't E41 be C17? But which tab was that? I've moved around too much. I'm sure they'll tell me in a minute. Straight gifts. Thank you. Straight gifts. What have I done wrong? E41. Oh, that's not that one there. Oh, you sorted it. Thank you, Paul. Oh, there's a phone going as well. Right. So where were we? Let's just go. So let's just summarize. I appreciate this is complicated. We looked at NIC. We looked at the kind of examples the revenue have done. And they suit their purpose. I think they're a little bit, I suppose misleading is not the right word, but they're not full and frank. Maybe they could have been a bit more helpful, but I guess wouldn't have suited their narrative of you'd be okay at 3 million. It only affects the biggest farms. The 1 million is not transferable. That is critical. Things need to be done. Ownership changed. Wills possibly changed. We talked about gifting. Yeah, that's great, but there is this taper and you can have this double tax, and it will depend on the base cost. I think it's going to be worse for limited companies because the base cost is likely to be significantly lower. And we sort of done a comparison of just so people can see the different effective rates. The one thing that I'm not sure about, because we haven't got any rules, but they introduced a anti-forestalling rule. So if any gifts were made before the day of the budget, they're fine. But if any gifts were made on the day of the budget or afterwards, and the donor dies after April 2026, those gifts will still be caught by the new rules. So they'll still have the £1 million and the 50% relief, which is not retrospective. It's not nice, but it's technically not retrospective. If they tell you what they're going to do, then when the legislation comes in later, that happens. It's permissible. The bit that I'm not sure about is, as it stands, I think you can still put assets into trust, and at this point in time, you would still get 100% business property relief. Whereas after April 26, I think that would be 50%. I think that it must follow because you use the same rules. Whether it goes into trust or it's on death, does it get business relief? What rate does it get? So at the moment, if you had a £2 million business and I think if you did this before April 26, you could always hold over the capital gain when you transfer shares into a trust. Doesn't matter whether the company's trading or not, you can do that. But let's assume it's a trading company. And we've got, at this point in time, we've got 100% business property relief. Therefore, we've got it into a trust. We're still on the 7 year clock. So if we don't survive that gift 7 years, I think it's still brought into account in the death estate, but we don't have an entry charge. Whereas from April 26, if you don't know how the 1 million allowance would work, let's just assume the £1 million allowance has been used. Relief would be 50%. I think, therefore, let's say it was a jointly settled trust, you would then usually have an entry charge. The entry charge is 20%. So there is this bit of nervousness around, well, should we be putting things into trust before April 26? Because doing it afterwards may be more costly. Let me go back to my I will come to the questions. I can see some, so I will revert back to them. So I've gone to that. Pensions. Yeah, I haven't got a slide on pensions, but what we know is that from, I think it's 2027, someone will tell me if I'm wrong, that they will supposedly, subject to any changes that happen between now and then, also be subject to inheritance tax, whereas up until then they will be exempt. Because it's 2027, it's not 2026, it's going to be later. The things I'm hearing are, well, let's wait and see. Let's wait and see before we work out what we're going to do. The complication, of course, with pensions is that if you die before 75, having not drawn any benefits, which I think includes your tax-free lump sum, whilst there might be inheritance tax if that's after April 27, the beneficiaries can then pull, I think, the whole fund out without paying any income tax. So there is that sort of, and you don't have to buy an annuity anymore. That used to be you have to buy an annuity at 75. That's gone. So there is this school of thought, well, why did I touch it? Because I'm making the position worse. If I don't need it, I'm just making the position worse for my beneficiaries. The sort of thoughts that I'm hearing are, I think, what they call recycling. So this idea that if you end up with a large pension pot, you don't really need it, and you were hoping to pass it on without inheritance tax, but now it's going to be clobbered for both possibly inheritance tax and income tax when the children, grandchildren draw it down. It might be better to draw down an income, even if that income is taxed at 40% or 45%, gift that income, but make those gifts in such a way that they are not even on the 7 year clock. So gifts out of surplus income are completely free of inheritance tax. So if you take the income that you don't need, it's clearly going to be surplus. And if you have a pattern of giving, you can't just do it once, but if you ideally you have a letter and you create a pattern of going, right, I'm going to give away, I'm going to take out 50 grand a year, I don't really need it, I'm going to give it to my son and my daughter and until it's exhausted. That would establish a pattern. So, okay, you've paid the income tax. Then the thinking is, well, what if they put it in pension? So, and it might be they only get pension income tax relief at 20%. But the thinking would be, well, it's better to take the money out and pay 40 or 45% in order to avoid the inheritance tax. If we can then give it to avoid the inheritance tax on the pension, give it away as gifts out of surplus income, so outside of inheritance tax altogether. And then if the kids or the grandkids then put that money into pension, you could effectively move the income tax from, say, 40 or 45 and get relief at, say, 20. At least the difference, the income tax suffered might be 20, it might be 25, but that could be better than paying 40% inheritance tax and then them taking the money out and paying more income tax. So there is, I think we may go back to what we used to have, this sort of concept of drawing down the income and giving it away, but adding on to that this sort of concept of, well, let's try and get the income tax relief back. So I'm not. I'm nearly done before I come to questions. I know it's been quite long. There's just a couple of things that I think would be worth mentioning. Um, yeah, so things to sort of watch out for. And these, I don't know the answers to any of these yet, but um, oh, it's spelt wrong. I don't like that. Better. Oh, that's worse. um, Anti-forestalling. So gifts after the budget will be caught if the death happens after April 2026. So you'll get that restriction to the relief. It just occurs to me that people make gifts, but they're not, the execution of the paperwork isn't always ideal. So, for example, if there has been a gift of shares and there's a stock transfer form somewhere and it's all dated correctly, etc., is the confirmation statement right? Is the share register being updated? I wouldn't want to be in a situation where someone queries the date on a stock transfer form and none of the other documents are there to verify that. And that I'm afraid that happens an awful lot. I sort of done that one. Oh, joint tenants. So if you hold property as joint tenants, the will does not get to decide where it goes. It passes to the survivor. And one of the things that would be a bit of a disaster is, say you've got say it was a farm and it was held by husband and wife as joint tenants, and therefore we can't get the benefit of the million allowance because we can't leave it to a trust or to a son or daughter. What we'd often do is rescue the situation with what's called a deed of variation. So the beneficiaries to the will vary it and go, no, I don't want it. Send it somewhere where we can get the husband, say, or the wife could vary the will. So you could sometimes you can rescue the situation with a deed of variation. But I think if you're joint tenants, I don't think you can. It's a legal question. And I think there's actually some lawyers on here, so they may be able to tell me. But I think if you've got things in joint tenancy, you might need to sever that into a tenancy in common so you can actually deal with them in your will, because otherwise I don't think it can be rescued. Partnerships, mainly general partnerships, but also LLPs. Now it's with shares. It's often we know what the percentages are because we know the shares. So we know that if someone's got 50% or 25%, because that'll be clear mostly. With partnerships, it very often isn't. You've got no partnership agreements. Sometimes the capital accounts may be a bit may not tell the right story. I think it's definitely worth revisiting those and go, well, actually, does our partnership agreement, do our partnership accounts reflect the true position? And unfortunately, quite often they don't, because for tax reasons, tax mitigation reasons, things will have been done. And quite often so for example, profits might have been allocated to mum and dad because they had more tax allowances. But as a consequence, they maybe not had that money and their capital accounts are growing. And so suddenly it looks like their ownership is more than you think it is. So I think that we need to look at those. I've talked about wills and powers of attorney. I can't remember why I put that in, but that might be useful. That's probably for, I think we've got a potential answer to the point of joint tenancies. And at the end of the chat, it's an interesting point. A variation that's interesting. It can, I can't pronounce, posthumously sever a joint tenancy, and that will be read back. So I think it can be rescued, but I suppose Andrew would rather not have to do that, and it would be better someone goes to see a lawyer like Andrew and gets these things sorted out. Right. So I've gone through everything. I'm just going to chuck in the questions to the chat. I've got one at the moment, which I'm going to try and take them in order. And this first one is, does a non-trading company have any IHT relief? No. An investment company, so business relief is restricted to businesses. It's a bit of an odd test. They haven't got to be trading, but they've got to be businesses, but they can't be businesses which wholly or mainly are an investment activity. And there's various sort of investment activities, but one of those is property. You can in certain circumstances, have a situation where if the property investment company is in the group and you trade from that property, well, that's fine. You sort of look at the group. And also, if the property investment is in the group, but it's actually let out, it can still, in fact, qualify. The whole company can, in fact, still qualify for the what would be the 50% relief. Are the business assets net total assets? Yes. So they will be. It will be the net. So if it's a company, you'll broadly be looking at your balance sheet and your net asset value, albeit it might be that there might need to be a revaluation for properties, which are freehold property generally isn't revalued, it's just depreciated. So there might need to be some revaluation of property. And of course, the goodwill value, the enterprise value, is not normally included in the accounts. It almost never is. So what will be quite interesting is just what are those valuations like? Because so, for example, I think farmland has just been devalued by 20%. In fact, it's ridiculous really with farmland, because if you value farmland based on the profits the farmers are making, you wouldn't pay anything for the land. Well, you wouldn't pay very much. So it'll be interesting to see what we do in respect of, because we never had to worry about it before. In fact, previously, really, if we had business assets, we wanted high valuations because they formed our base cost. I think now we'll be much keener in terms of demonstrating effectively potentially low values. What if you gift and your children die before you? It doesn't change the 7-year rule. The rule with the 7 years is that it's not, if it's business property or agricultural property, it's not sufficient that you give it away and to get the relief, that tapered relief, live those number of years. The individual you gave it to has to carry on owning it. So let me explain that. So if I gave my trading company away, but then my son or daughter sold that business and just sold it for cash, and I didn't live the 7 years, there would be no business relief. They have to hold on to it until ideally I've gone. But I don't think it matters if anything happens to them, as long as the people they've left it to have retained it. So if it ends up with the grandkids and they sell it, I think you end up back in the same place. How do they define property, and who does the valuation? So I'm not sure the first question is Helwyn. So for these purposes, we're talking about shares in trading companies for business relief, farms for agricultural property relief, but business relief will also apply to partnerships and sole traders. So if, for example, you have whatever reason you're a sole trader business and you've got a sweet shop and you've got the goodwill and you've got your stock, and the cash in the business, all that would be added together to work out the value of your sole trader business. Straight cash gifts, what records, notifications are required at the time of the gift? That's a good question. I get that question quite a bit, and the answer is none. There is no requirement to, and never has been, and there's no noises that there ever will be, but there are no requirements to notify HMRC of the gifts. It is the obligation is on the executors to make an account of any gifts that took place in the 7 years before death, and they've just got to do what they can in the circumstances. The reality is they will know some of them because they probably are the beneficiaries and received them, but with the best will in the world, they can't necessarily um, be absolutely aware of everything. I suppose what I'd say from a practical point of view, I always think it's better that the executors are, and I know there's appreciate some lawyers on here, but I always think it's better that the executors are not lawyers or professionals, but are the family, but they go and get advice from lawyers and professionals so that those when there are difficult decisions to be made, I think family can be more pragmatic than we can because we don't have that luxury, I'm afraid. Oh, that question's there twice. I think I'm not. I think I've answered all the questions that have come in actually, and I'm 8 minutes away from the hour, which is good. Um, that's a comment, not a question. I think everyone could see these. Oh, another question. Oh, there's no. So when do we do our business valuations? There's no need to come. There's no immediate need to go and carry out business valuations. Um, they, I think, even in respect of gifts where the gains have been held over, there would be no need to do a valuation because it wouldn't be in point for an inheritance tax perspective if unless death occurs within 7 years. When you do the holdover of the capital gain, it's quite acceptable to put an estimate in for the value. And what I would typically do, because at the point you do that, you don't really know whether you want a high value or a low value. So what I would typically do is simply take the net asset value. And then if it's query, like say, well, it didn't matter because the game was being held over and it was an estimate. And so I did the pragmatic thing that didn't cost my client any money. I just took the net asset value. But now it matters. Actually, we think the value is X, Y, or Z. But I wouldn't be rushing now to go and do valuations. If anything, we generally, we will be careful, but we generally want to use the benefit of hindsight. Right. I think we end in 6 minutes. So unless there's any other questions, I'll just hold on just a little moment, just in case there are. Oh, oh, I think there's one more, but it's being um, typed out. So I've got a question. Oh, here it is. So I wasn't sure if there was a question. Uh, can you clarify if business stock needs to be valued on death? Yes. So the valuation for this is a company, a question, I think, in relation to a company. So for a company, it's all the assets in that company. From a just think if you think about it practically, the the sorts of things that might be done. So if you're concerned about uh, the value appearing too high, if you've got if you've got freehold property that you trade from, it is generally not held at market value. It's generally held at cost and depreciated. That's fine. You leave that as it is. Maybe there's an argument about what that valuation is, but you're not saying it's more than it's worth. If anything, you're saying it's less than it's worth. The goodwill value, so the trade, the enterprise value is almost never in the accounts. Um, the so you would have that argument after the event. The stock, you might pragmatically not want to be in a situation where you have overvalued your stock. So if you think actually, I'm not going to realize 1 million for my stock, I should put a provision against it. And there might be other good commercial reasons why you don't want to do that. That might be, oh crikey, I don't really want that loss, even if I can get tax relief on it. I don't want the bank, whatever it might be. So there might be commercial rationales for not doing it, but if there's not, you might look at it and go, well, I don't want the revenue thinking, I don't want to be arguing with the revenue. I need to put my stock in what I think is the right value. In terms of other sort of valuation points, when you come to do the enterprise value, it's quite normal to adjust your EBITDA, your earnings before income tax, depreciation, amortization. So what is seen in the accounts is not necessarily like the true figure for an earnings purpose. So the easiest example is quite often you look at companies with an EBITDA and say the EBITDA is £500,000, and you look at it more carefully and you go, oh, do you know what, the directors only pay themselves £12,000 a year. So immediately you'd go, well, actually, I think for this company, a director would cost us £100,000. So you can make adjustments after the event, and there's adjustments can be both ways. You know, we're trying to sell the company. The adjustments generally are, well, there's some bit of personal expenditure over there, but there are things that can be done, and it's probably, whilst I wouldn't necessarily go and do a valuation, it might be just as well to sort of have those discussions around, well, what might it look like? Am I doing anything? Am I putting the wrong foot forward in the way I'm presenting my accounts? Because actually, I'm now more worried about the inheritance tax than I am about the bank or my credit rating. I'm sure it'll be a balancing act, but it will be another bloody thing to throw in the mix and try and work our get our heads around and come up with the best end position. Yeah, and land. So land, they frustratingly they have a share asset valuation division for shares and a district value for property and land. This is the revenue, and they will just send off the district. They'll send off land values to the district valuer. And the best advice, I suppose, is that the person that's valued the land for us or for you is ideally a valuer that has a track record of having an argument with the district valuer, because it's always the same people and they get to know each other, and so they're the ones that will get you the best result. They will be RICS. I can't know what RICS stands for, but they will be of the RICS Institute Red Book valuation. You need one of those sort of people, because they'll be the people that are good at arguing with the district valuer. Right, I'm exactly on 5 o'clock. So I think we are good to go. Yes. Well, thank you, everybody. I hope that was informative. I apologize if it was complicated. I didn't make it complicated. It just is complicated. And I made it as simple as I can, but it's not necessarily that simple. So, yeah, okay. Just that's very kind of you. Thank you very much. Brilliant. There will be a recording, and yeah, don't send me clients. I'm far too busy, and the spreadsheet's all mine. Okay. Thank you, everybody. Have a good evening.